Hey everybody, it's Bob Mortgage, and here's this week's mortgage report. If you're in the market to purchase a home or pay off that 2017 debt with a refinance, give me a call at 214-631-5626, or you can apply online at BobMortgage.com. This week, I'm going to give you our forecast and outlook for 2018. Now first, I have to hand it to my capital markets team and my team of advisors. They crunched a lot of data so that I could deliver to you my outlook for 2018. And I take my team of advisors very seriously. One of them is even considered by Zillow the most accurate real estate forecaster in the United States out of their top 150 economists. So let's take a look at what stocks, bonds, the Fed, interest rates, and housing is going to do. With regard to the stock market, well, we feel that there will be a possible stock market pullback now that the tax plan is in place and because we had such a big run-up in 2017. Investor optimism is extremely high, and that can be dangerous. We also are seeing the most expensive stock market ever, and we're getting dangerously close to the stock market run of 2000. And we all know what happened then. Now, I'm not saying we're going to have that kind of correction or pullback, but we have to look at historical data to make good decisions going forward. So how will this affect housing and interest rates? Well, interest rates could actually benefit from a stock market pullback because both the stock and bond market compete for the same investment dollar. So if money is leaving the stock market, then it's going into the bond market, which drives interest rates lower. Now with housing, it could be a bit of a different story. If people start to see their stock portfolios decline, it can make them less likely to make other big investments, like buying or selling a home. All right, let's take a look at the Fed. In their last meeting of 2017, they said they're going to hike rates 3 times in 2018. Well, those people aren't the ones voting in 2018. The Fed has a new look and agenda. Yellen is out and Jerome Powell is in as the new Fed chair. Also out is Vice Chair Stanley Fischer and New York Fed President William Dudley. That's their top 3 positions. So it's a big changing of the guard. Trump's going to have to appoint up to 4 Fed governors, and that would lead us to believe that the Fed will be just a bit more hawkish. But one thing that is set in stone, they're going to further unwind their balance sheet. Now, the Fed was buying about $25 billion a month in mortgage bonds. They were very active in the bond market, and it helped keep yields low. Well, last October began reducing their purchases by $4 billion per month. Starting in January, that will be reduced to $8 billion per month. Then in April, they will reduce it by $12 billion. July will go down by $16 billion, and we'll finish 2018 in October with a reduction of $20 billion a month in MBS repurchases. That's going to make for an interesting 2018. With the Fed in the market going to keep the buying, who will replace them? Yields will have to be attractive, and that's one of the main reasons we feel interest rates will increase in 2018. So how many times will the Fed increase interest rates? Well, we feel that the Fed will ultimately increase 2 times, one in March and one in September, versus the projected 3 times because of the stock market pullback. Now, if Trump appoints a very hawkish Fed, then we could see possibly another rate hike. With all that said, all indicators point about to a 0.3% increase in 2018. Now that's an average increase from 2017 to 2018. So at some points during the year, the rate may be a bit lower, and other points of time it could be a bit higher. But at the end of the day, we expect an average increase of about 0.3 point in interest rate. Now housing, we believe, will be phenomenal, okay? We closed out 2017 with incredible numbers with new construction and existing homes. We have great momentum because of low inventory. Rents are still going up at about 4% per year, and we don't feel the modest rate increase will derail purchases because demand remains so strong. We also don't see the new tax plan negatively impacting the real estate market. The capital gains piece remain unchanged. All you need to do is live there for 2 out of the 5 years. Now, regarding the change in mortgage deduction, well, only 21% of tax returns filed in 2017 actually took the mortgage deduction, and in 2018, we feel that only 4% of tax returns filed will take the mortgage deduction, and that's because the doubling of the standard deduction, that will take a lot of the incentives out. So with all that said, we feel on a national level, we should see about a 4.5% to 5.5% appreciation. Now here in Texas, we're thinking a little bit bigger. Now bottom line, we feel 2018 2018 will be a great year. Look, I've been a mortgage advisor for over 20 years and have been blessed to provide financing to over 25,000 families. I watch the markets to make sure I can deliver to you the right home loan product at the right price. I'd love to help you with your home financing options. Give me a call. With Bob Mortgage, your dream home is already within your reach.